Hello and welcome to my new YouTube video on the Easy Finance channel. My name is Luca and today I'm going to explain everything you need to know about the income statement. If we speak about financial statements, we have the four main financial statements, which are the balance sheet, the cash flow statement, the statement of changes in shareholders' equity, and today's topic, the income statement. If you haven't checked out the videos on the other statements, be sure to find the links in the info box below. Why the income statement is so important, maybe the most important one out of the financial statements, I'm going to explain you in this video. But first, let's start by defining what an income statement is. Basically, an income statement is a financial statement that gives us an overview of a company's revenues and expenses over a specific time period. We distinguish between direct and indirect cost. The income statement is also known as the profit and loss or P&L statement because it directly shows whether a company made a profit or a loss during the time that we analyze. Normally, the time period is a month, a quarter, or year, but sometimes the analyst time period is a fiscal year. A fiscal year is used to describe the business year, which may or may not coincide with the calendar year. An example for the fiscal year is that it runs from April 1 to March 31 of the next year. So far in our definition, we learned that we can express the income statement with the basic formula. Revenue minus expenses equals profit or loss. I created also a few exercises for you to this video topic, so check out the links in the info box below to find them. Before we dive into an example, it is important to know that the financial statements are based on a set of guidelines called Generally Accounting Principles, or short GAAP. These guidelines are not exact rules, but to really understand accounting, we need to understand the different guidelines. So, GAAP is exclusive for the US. In other countries, the guidelines are called International Financial Reporting Standards, short IFRS. These standards, similar in many ways to GAAP, are used all over the world. To better understand the GAAP, I show you two principles as an example. An income statement prepared using GAAP will show revenues when it accrues. This means that it's not necessarily the moment when the cash comes in. This means the revenue is to recognize when the selling process is complete and the product or service is going to be exchanged. Normally, it means that the revenue is to be recognized at the time of the sale. The expenses shown at the income statement are recorded after the matching principle. The idea behind this is that we have to match the cost accrued with the revenue this cost helped to generate. So, if we run a business and we produce a product and sell this product on credit, we have to recognize the revenue although we didn't receive the money based on the revenue recognition principle before. After this, we have to look which cost occurred to generate this revenue and note them down for the same time period where the revenue is recognized. A difference from the cash flow statement and the income statement is that in a cash flow statement, we only see the cash in and outflows, but sometimes there are non-cash items. A very popular non-cash item is depreciation. Here we have no cash outflow, but a cost. If we bought, for example, an office building for $100,000 and we have a yearly depreciation of $20,000, our office building decreases $20,000 in value, but without a cash outflow. We are only deducting this $20,000 as an expense. There are different methods for depreciation, but this would take so long to explain them all that we created an extra video for this, so check this out. So, the basic structure of an income statement is that we start at the top with the revenue of our company. Mostly this consists out of sales revenue. Below the revenue we have the cost of goods sold. The cost of goods sold are the direct costs that we can directly trace down to the product we have sold or the service that we provided. If we deduct the direct cost from our revenue, we get the gross margin or gross profit. The next step now are the indirect costs. These are the costs that cannot trace back to a product or service. They are the normal cost occurring with running a business. They are also called overhead expenses. Examples are rent or insurance. We cannot trace them down to a specific normal cost that we have from running our business. If we deduct this overhead expense, we finally come to our operating profit or loss. So, let us use a few numbers to understand it better. We founded this solar limited company and we are looking at the income statement for the time period 1st of January 2021 to 31 of January 2021. So we take a look only at the January of the year. In the January, we did a very good job in selling our solar panels to clients and generated a sales revenue of $10,000. But we had also a lot of expenses on the other side. Our cost of goods sold, so our direct costs that we can trace down to the product, are $2,500, which leads us to a gross margin or gross profit of $7,500. Our indirect costs are our office rent with an amount of $1,000 and our company insurance with $500 per month. Deducting the indirect cost from our gross margin leads us to operating profit of $6,000 for the January. Very important is that we compare our income statements over time. Only then we can see the progress of our company and identify the trends, whether positive or negative. So on this slide we can see an income statement comparison. It is very important to split down the income statement into specific areas like here in revenue, direct expenses, indirect expenses and profit. Why? Because only if we split down the income statement in the areas, we can identify the trends of the specific area. For example, we have here from November to January an increase in the revenue. But in the latest area, we see that there was firstly an increase to December in the profit, but then a decrease again. So revenue is the same in December and January. But why is the profit lower in January than in December? To answer this question, we can look at our expenses and directly see, okay, the direct expenses were higher in January than in December. And then we can look why was this? Was maybe our direct material more expensive or what happened? Then to summarize everything, the income statement shows revenues, expenses and income over a specific period of time, normally a year or a quarter. The GAAP and IFRS providing guidelines for creating the financial statements. And finally, comparison is very important to identify the trends as we discussed in the latest slide. So the download links are in the info box, and if you enjoyed this video then please like it and write down in the comments which topic you want the next in my videos.